In 2007, Warren Buffett offered a bet that sounded almost arrogant. He'd put $1 million against a hand-picked group of elite hedge funds. His claim was simple. A boring, low-cost S&P 500 index fund would beat them. Ted Cetus, a hedge fund manager, took the bet. He picked 5 funds run by some of the sharpest minds on Wall Street. By the end of 2017, it wasn't close. The index fund returned 7.1% a year. The hedge funds returned 2.2%. Total gain over the decade, roughly 126% for the index fund, versus a fraction of that for the professionals. By the end of this video, you'll know exactly why that happened, and why it wasn't a fluke or a lucky decade. You'll see why buying the whole haystack tends to beat searching for the needle, again and again across markets and decades. And you'll know exactly what an index fund actually is, in plain terms, so you can decide if it belongs in your plan. Here's the basic idea. An index is a measuring system, a scoreboard tracking a defined basket of investments. The S&P 500 tracks roughly 500 of the largest publicly traded American companies, weighted by their size. This isn't a new idea dressed up for the internet age. The first index fund for everyday investors launched back in 1976. Built by John Bogle at Vanguard, Wall Street mocked it at the time, calling it un-American to settle for average returns instead of trying to beat the market. You can't buy an index directly. An index fund is the actual product built to copy that scoreboard as closely as possible. Buy one share of an S&P 500 index fund, and you own a tiny slice of all 500 companies at once. No stock picking, no guessing which company wins next year. Just ownership of the market exactly as it's weighted. As companies grow, they can take up more weight in a market cap weighted index like the S&P 500. When companies no longer meet the index's rules, they can eventually be replaced. You never have to personally identify the next winner. The index quietly rebalances around whichever companies actually succeed. That matters more than it sounds like it should. Most of a stock market's long-term wealth comes from a small number of companies. Finance professor Hendrik Bessembinder found that just the top 4% of listed U.S. companies accounted for the market's entire net wealth creation above Treasury bills. The rest collectively performed roughly in line with short-term government bonds. Most of the magic came from a small handful of extraordinary winners. Nobody hands you that list in advance. Before a company transforms an industry, it usually looks expensive, unproven, or forgettable. A broad index fund solves that problem by simply buying the entire field. When the rare winner emerges, you already own a piece of it. Think about it this way. Instead of hunting for the one tree that grows tallest, you simply own the entire forest and let it grow. The second reason index funds win so consistently: cost. Someone has to pay for the analysts, the trading, and the research behind active management. That cost gets passed to you as a fee, often 1% a year or more for an actively managed fund. An index fund, following a fixed set of rules instead of a research team, usually charges a fraction of that, sometimes under 0.1%. That gap sounds small. It isn't. The SEC has specifically warned that even modest ongoing fees compound into major losses over time. Put $10,000 into 2 funds, both earning 8% a year before costs. One charging 0.1%, the other charging 1%. After 30 years, the low-cost fund grows to roughly $98,000. The high-cost fund grows to about $76,000. The starting gap was under 1 percentage point a year. The ending gap is more than $20,000, quietly siphoned off in fees. Here's the deeper reason active management struggles to win, and it's simple arithmetic, not opinion. Active investors together are the market, for every investor who beats the average. Someone else on the other side of that trade has to fall below it. Before costs, active and passive investors collectively earn roughly the same return. After costs, the higher fee active side has to fall behind. Nobel laureate William Sharpe described this decades ago as simple arithmetic, not a theory, a mathematical certainty about aggregate returns. That's not an opinion about which managers are smart. It's a closed mathematical loop that applies no matter how talented any individual manager is. Some active managers absolutely do beat the market. The hard part is identifying them in advance and telling skill apart from a lucky stretch. In 2025, according to the SPIVA US scorecard, 79% of actively managed large-cap U.S. equity funds underperformed the S&P 500. That single year isn't the whole story either. S&P Dow Jones indices tracked funds that were above average in 2021 through 2025. Only 4.5% of those top performers stayed consistently above average the entire time, worse than random chance would predict. The fund manager who looks brilliant this year may simply be holding whatever style of investing happens to be working right now. By the time their strong track record gets your attention, the best part of that run may already be behind them. Investors then make it worse by chasing that track record, buying in after the big gains, right before an ordinary stretch begins. That cycle of buying yesterday's winner and selling after disappointment is one of the most consistent ways people quietly underperform their own investments. An index fund removes most of those decisions entirely. You don't have to guess which sector, which manager, or which company comes next. You simply accept the market's return, and the market's return is the combined output of some of the most profitable companies on Earth. That's not settling for average. It's declining to gamble on identifying every winner in advance and owning the outcome instead. But index fund doesn't automatically mean safe or simple. The label describes how a fund is built, not what's actually inside it. There are index funds tracking single countries, single industries, leveraged strategies, and narrow baskets of 30 speculative companies. A fund like that is technically an index fund. It is nothing like owning a broad, diversified slice of the total market. Before buying one, know what index it follows, how concentrated it is, what it costs, and whether it matches your actual time horizon. Money you need next year shouldn't sit in the same investment as money you won't touch for 30 years. A broad stock index can still fall 30 or 40% in a bad year. Diversification doesn't prevent a market-wide decline. There's also a quieter benefit worth mentioning: tax efficiency. Index funds trade rarely, which usually means fewer taxable gains passed on to you each year. Actively managed funds, by contrast, often generate real tax bills even in years when the fund itself actually lost money overall. What it prevents is one company's collapse from wiping out your entire portfolio, a very different, more survivable kind of risk. So the real work with an index fund was never picking stocks. It's behavioral, staying invested when headlines turn frightening, not selling after prices already dropped, not abandoning a sensible plan because someone online got rich on one lucky stock. There will always be a company that outran your index fund this year. There will always be someone claiming they called it early. You rarely hear from the much larger group who made equally confident predictions and were simply wrong. Quietly, off camera. An index fund accepts something humbling. You don't know which company wins next. Neither does the analyst confidently explaining it on television. So instead of betting on one company, one sector, or 1 year, the index investor makes a much broader bet. Businesses will keep competing. Most will be ordinary. A small number will become extraordinary. And you'll already own a piece of whichever ones do. That's what an index fund actually is, a low-cost way to own a defined slice of the market without predicting its winners. It's not a shortcut to guaranteed wealth. It's not protected from crashes. It won't make a good dinner party story. But it consistently beats the alternative that demands you repeatedly predict the future. Pay more to do it, and stay emotionally disciplined the whole time. In practice, that's often just 3 funds: a total U.S. stock market fund, a total international stock fund, and a bond fund that grows as you get older. Bogleheads call this the 3-fund portfolio, and it's been used successfully by ordinary investors for decades. Set up automatic monthly contributions so buying doesn't depend on whether you feel confident about the market that particular week, then genuinely leave it alone. The single biggest risk to most index fund investors was never the market. It was their own hand-hitting sell: diversify, keep costs low, invest consistently, give it decades, not months. That's the entire strategy, stripped down to its actual mechanics. The most successful investment usually isn't the one that makes you feel brilliant. It's the one that quietly removes the need to be.